There's plenty of bad investment advice out there, and if you've ever fallen victim to it, you have plenty of company. And with more and more baby boomers nearing retirement age, many need a better investment strategy to reach their financial goals. In a new book, Yes, You Can Supercharge Your Portfolio, best-selling author Ben Stein and investment advisor Phil DeMuth write that most investors make the big mistake of trying to pick a single winning stock or mutual fund, rather than building a well-performing portfolio. They offer 6 steps for investing success in the 21st century, how to create a properly diversified portfolio that delivers a maximum return.
Well, joining us now is the co-author of Yes, You Can Supercharge Your Portfolio, Ben Stein. Ben, delighted to have you.
Honored to be here, sir. Honored to be here. Thank you.
Thank you. We think of you as possibly a comedic person and a commentator, but not too many people know you as a law graduate and a financial expert.
Well, I'm somewhat of a financial expert. I mean, in these last few days, I don't think many people have been financial experts.
In your book, it's interesting. You basically are saying if you haven't got much money, don't be worrying about portfolio, and especially if you owe $30,000, $40,000 on credit cards, pay that off first.
Pay that off first. Get yourself out of debt and get a cash balance. Get a cash reserve. I mean, don't think that you have to be in the stock market. You're not J.P. Morgan. You're not a Wall Street plunger. Get yourself $10,000, $20,000, $30,000 as a cash reserve. Then start thinking about stocks.
The other thing you said is that people needed to kind of chart their course before they decide what portfolio strategy.
Well, they have to think, how long do they have until retirement? Mm-hmm. How much time do they have to absorb pitches and turns and fits and starts in the market? If they don't have much time, if they're just starting in their late 50s or early 60s, they should have a good chunk of cash. They should not have that much in the way of stocks. But if they have a good amount of time to prepare, say 30, 40 years, 20 years, they should be mostly in stocks. Stocks, even with the current turmoil, are going to yield much more than bonds, cash, or real estate, or even gold.
What about foreign stocks, foreign currencies?
I love foreign stocks. The dollar is in an endless slide. It may have some brief reversals, but the foreign stocks that are going to be translated back into dollars when you sell them are a great thing. There is the way we've set this up, it's almost unbelievably simple. You can have the basic couch potato portfolio, which is half the total Vanguard or Fidelity total bond market portfolio and half the total stock market portfolio from Vanguard or Fidelity. The costs are almost nil. There are going to be times when the market is going crazy like it is now. You won't make money no matter what you do unless you're selling short. But for the long run, you'll do great. And I may add, if you have money, if you've got a strong stomach, now is a very good time to buy. Buy when there's blood in the streets. Buy when there's total pessimism. That's the time to buy, but only if you have a long time horizon, if you can afford a lot of turmoil, and if you have a strong stomach.
You ride the winners, or
I would ride the winners, but I would ride the winners in the form of the index funds. I hardly ever buy individual stocks. The only one I buy in any significant amount is Berkshire Hathaway, Warren Buffett's company, and it is itself sort of a mutual fund because it has so many other stocks within it. But for the others, I rarely buy individual stocks, except high dividend stocks, because I'm 63. I'm going to eventually, I hope, retire and live more quietly. I want the income. You can buy REITs, real estate investment trusts, now yielding over 10%, quite a solid 10% return. A 10% yield in today's world is miraculous.
I kind of like to shoot for 20% a year. Have you got to go?
I cannot even remotely promise 20% a year. I cannot even remotely. In the foreign stocks, the emerging markets, and the European, Australasian, and Far Eastern developed stocks, we've been getting 20% a year for the last several years. This year, it's way down. If you can get 20% a year, Pat, you should be writing this book, not me.
I'm too modest to write the book.
If you can get 20% a year, you're way out of my league.
Well, this book is called Yes, You Can Supercharge a Portfolio. This isn't, this isn't a book for dummies.
It's a pretty serious book. I mean, if you just read the introduction and the last chapter, you basically get the idea of it. But in the middle of it, it's pretty serious stuff, and you could just get the idea from just reading the first and last chapter. And the book only costs a few dollars, basically, and it'll save you an awful lot of money over the long run.
Well, it's tremendous advice from a man who knows. And ladies,
well, I don't seem to know as much as you, because believe me, I don't shoot for 20% a year.
Well, you ask, you have not because you ask not. But in any event, where you get this in bookstores, it's available.
Or on Amazon.
Amazon.
Right.
Ben Stein, you need to get this book. It's very interesting, and it takes a little work. You just don't thumb through it.
No, it's not child's play.
You have to study. You've got model portfolios all the way through.
I know, but it basically just divided up among domestic, foreign developed countries, and foreign developing third world countries, and bonds. Do it with ETFs, low-cost ETFs and low-cost index funds. Over a 20, 30-year period, you're going to make so much money, it'll make your head spin.
Well, Ben, this is very interesting. I appreciate so much you being here.
I appreciate your having me so much. It's wonderful being here, and I stayed at your hotel last night, the Founders Hotel. It is incredible. It's as good a hotel as I've ever stayed at anywhere in the world.
We've got that on tape. Thanks, man.
Thank
God
you so
bless
much.
you.
Thank you
for
so
being
much.
here.
Thank you.